for more on the European debt crisis, we now go to Vincent Truglia. He believes default by Greece is a foregone conclusion and the EU is doomed. Vincent is Managing Director of Global Economic Research at Granite Springs Asset Management. He was the head of Moody's Sovereign Risk Unit and also worked at the New York Fed. And he joins us now in studio to discuss how the European debt crisis will impact us here in the U.S. Vincent, it's a pleasure to have you here in the studio. Welcome to Fast Forward. And, Adam did an interesting picture there, or slide there, putting this crisis into context for us. So why are the events of the European Union and the Eurozone and the ongoing debate over what to do with Greece affecting so many of the markets around the world?
Well, first we have to, I think, make a distinction between the European Union itself and the Eurozone, which is a component of the European Union. And for markets are affected because if there is a default, then there will be defaults on a lot of credit default swaps, and it's not clear who holds these. It's not clear who would gain if there's a default, what banks would be affected around the world, and the question is, how do you prepare for what I think is an inevitable conclusion, which is that Greece will default. It may default in 1 month, or it may default in 6 months, or it may wait a year or so, but it cannot sustain debt at these levels without a big haircut, meaning default.
Well, there is some issue, though, around the semantics here, right? What is a default as defined by a rating agency? What is a default as defined by credit default swap holder? What is default as defined by the government? What is the likeliest scenario? And give us in very plain English what default will look like in Greece's case.
The problem is it's not clear what default will look like in the near term. And as your colleague was alluding to, rating agencies might conclude that distressed exchange, in fact, they definitely will conclude it's a default. But then would that be a credit event under law? And I think a lot of lawyers are going to make a lot of money fighting this in the courts if we get to that. But it's really just a question of time. If Greece stops meeting its payments and, or for instance, exits the Eurozone completely, then it is clearer. But it's waited so long to do this that no matter what's going to happen, the Greek situation is going to look rather chaotic.
And there is he was called it the pigs there, but there is a real risk here of contagion. Already the market is pricing in contagion in a number of the surrounding countries there. Right. Which do you think are the most likely to fall, or be severely impacted, or potentially default on their own debt as a result of Greece defaulting?
Well, I think the next weakest link is probably Portugal. And after Portugal, I would put Ireland, followed by Spain, and then quite a bit of a way off, possibly Italy. And there, again, I would go that they should leave the Eurozone because the monetary union that they have now just won't work without a large federal government to transfer balances from gainers to losers. Just doesn't exist, and it won't exist any time in the future.
Let's fast forward a year, 5 years from now. What do you think the European Union will look like? Do you think it will exist in that time frame?
Well, I think the European Union will exist. They're obviously going to have to make some changes if some Eurozone members leave the Eurozone. But those are details that can be dealt with by the Europeans. Treaties can always be changed.
And then let's quickly connect the dots for us here back to the U.S. This is one of the many things that are weighing on investors' minds in terms of risk to U.S. growth. What has to happen over in Europe for us to feel better here?
Frankly, I don't think there's very much that can happen in Europe, even in the near term, that would make us feel better. But there are a lot of things that could make us feel worse, and that's the concern. But added to that, the Eurozone crisis was not caused by the U.S. We have nothing to do with it, but we could be affected. Right. The real risk is that if we don't deal with our debt ceiling while the Greek crisis heats up, then we could have a serious financial problem around the world.
You actually outlined an interesting scenario here that talked about growing European nationalism as a potential threat to U.S. growth, Japan's latest recession, and then you also talk about commodity prices crashing as part of that.
Exactly. You have the possibility that if Japan is now in another recession, this is clearly not good for world growth. Chinese growth is slowing. Commodity prices, except for a very few of them, are clearly overpriced if you look at traditional marginal cost pricing. And we're sitting on a marketplace where you better be following events very closely and making sure that you're not negatively affected by any of these phenomena. And they're all out there and sitting there. And I think this is why investors are concerned.
All right, Vincent, appreciate your insight. Thanks so much for joining us here on Fast Forward. That was Vincent Truglia of Granite Springs Asset Management.